Hi, I'm Peter Lundgren, founding CEO at Lundgren's Capital.
And I'm Mel Lopez, Chief Economist for ASEAN.
Welcome to Sound Economies with Mel and Peter, an East meets West podcast by Lundgren's Investor Insights. Here we share what we're focusing at in economies and financial markets from the developed and the developing world. Hello, Mel. Good to see you again. Welcome. How are we today, and how's your week been?
Hi, Peter. It's great to touch base with you again. It's been an eventful week, so we are in the middle of preparations for our next global quarterly magazine. So I'm looking forward to finishing what we have and putting it out for our subscribers very soon. How about you, Peter? What have you been up to these days?
Yeah, a lot of things. Also, if a lot of people have followed what happened also last weekend, and defense budgets are getting increased again here in Europe, and we have our own defense high-tech defense fund that we established for almost a year ago now, and investors are of course so interested talking to us about the fund and opportunities to invest into to defense. So there's a lot of action going on. So that's interesting. Otherwise, across the world today again, we will start where the sun rises in Japan and the Philippines,
Right.
with and actually with the rice story, rice
Mm-hmm.
sea. Then we go to China, two mighty men. They met in Europe. We having a look at the inflation check again, a bit more
Mm-hmm.
extended this time, and we will touch base in the end on the US dollar, called the greenback, and of course, always we give our view on the global outlook and how happy we are or nervous. Mel, please tell about what you were talking about on the rice story in Philippines and Japan and all.
Right, Peter. So, a very exciting development here in Asia. Well, not so positive, but there are rice supply concerns, particularly in Japan and the Philippines. So, the problem in Japan and the Philippines actually started in late 2024, but we're seeing um, that it has persisted into 2025. So, according to our external contributor based in Tokyo, the rice supply woes in Japan started in the summer, and they've had to contend with greater demand in a mix of increase in tourists who want to try local sushi, for example. And of course, there's climate change, and um, households are also stocking up on rice over the winter. And now the result is that there is quite a shortage happening in terms of Japanese rice. So what they've had to do is to import more. And recently, the government decided to release 210,000 tons of rice from stockpiles to bring prices down. And in 2024, rice inflation was actually at 28%. So that's pretty steep.
Yeah.
And that's been the same route taken by the Philippines. So just a couple weeks ago, the government declared a food security emergency concerning rice. And they've also started releasing stockpiles of rice to bring retail prices down.
Mm.
So everyone here eats rice basically. So it makes it a political crop. And this is seen to persist in the next couple of weeks, maybe months. And our key takeaway here really is inflation will remain elevated in this part of the world.
Yeah.
And that is another reason to hold off on rate cuts, at least in the coming weeks or months, because, yeah, that's food inflation and it really takes up a big chunk of the basket, of the consumer basket. So
Yeah.
that's something we're monitoring. But yeah, otherwise, inflation will remain
Yeah.
higher than what central banks would like to see them.
Exactly. And the trouble with rice is it's very difficult to substitute. Yeah, as you mentioned,
Yes.
also in Japan they're trying to import more rice. First of all, it's of course not really so good for the Japanese people because they want their own domestic rice. Yeah,
They
first of
love
all.
their, yeah.
Yeah, and but for as let's say in the Philippines, Imported rice is more expensive.
Yes.
That's a problem because many in the Philippines are forced to, simply to include rice in their daily meal. And you can't substitute, you can't substitute with potatoes or whatever, yeah. And in Japan, it's hard to make sushi on a potato and all this stuff, yeah. But that's again, you could call it a luxury problem. But it is actually hard to substitute. This is worth to keep an eye on. What about in the other Southeast Asian countries? Is rice sort of how to say it, as it to be funny on the rise as well?
Well, we don't see that problem yet in like major rice producers like Thailand and Vietnam, for example. But of
Yeah.
course, the greater demand is pushing uh, prices up in the global market. So that is the immediate effect of these supply issues in countries like Japan and the Philippines, Peter.
Interesting. Let's jump to China and the two mighty men, President Xi met with Jack Ma.
Yeah,
Uh,
that's a very big milestone as far as the
yeah,
past 5 or so years are concerned. So,
yeah,
President Xi Jinping met up with tech executives of Chinese companies last Monday. So, that's February
yeah.
17th, including, of course, Jack Ma of Alibaba, as well as the CEOs of like WeChat, Tencent, Xiaomi, Huawei, BYD, and of course, the recent crowd favorite, DeepSeek. So, I think this, more than anything, is not just a typical courtesy call, so to speak, but it's more of a recognition from the end of the Chinese government that private businesses can and will drive innovation and growth more than government spending and state owned corporations alone. I think the Chinese government and the CCP are more open now to the thought that purely privately run businesses can stimulate growth more than government stimulus. Because recent winners, we've seen BYD catch up with Tesla, for example. We've seen DeepSeek catch up with ChatGPT and OpenAI. And more than anything, the President Xi and Jack Ma encounter is kind of symbolic that China is releasing its chokehold over the technology sector. So we know that in 2020, the Chinese government shot down the Alibaba listing, the IPO,
Yeah.
all because Jack Ma apparently spoke bit too negatively about tight regulations of the government. And
Indeed.
looking back, he was probably right. Because here they are, 5 years later, shaking hands and finally, I guess, kissing and makeup, if that's it. Because there's a commitment now from President Xi to reduce fees, to provide more policy support towards the technology sector. Times have changed. This could lift business confidence towards China better, especially now that they need private sector to help drive growth, which has been slowing over the past couple of years, Peter.
This is really interesting. It is interesting, and we are paying a lot of attention to this. And yes, back in 2020, Jack Ma, he was the biggest on the
Yeah.
corporates of the corporate stars in China, and he thought he was so big that he could criticize presidency. And okay, yeah, that caused the IPO was delayed after that. That happens. But now, yes, we consider this as an opening towards what we call the private sector in
Mhm.
terms of giving more room, giving more space, giving more acknowledgement of the private sector, of the private sector companies as elites. And then it's fascinating to see how the two biggest presidents in the world they meet up their tech companies and hold them close to themselves. Yeah, as they're lining up the battlefield, also the corporate global battlefield.
Right.
Yeah, this is mighty. We should not underestimate. It also underlines how big the tech companies are and how important they are viewed. Meaning, as we've talked about, they take up a decent space in the stock indices, but it
Yeah.
will continue. There will be swings, yes, there will be sell-offs, but they will continue to be mighty. Very interesting. This both sort of for them from a global perspective, but particular from the Chinese perspective. Yeah, a fantastic topic, Mel, to bring forward. Otherwise, here in Europe, yeah, what should we say? Today we will we will focus a bit on the inflation. Yesterday, that means Wednesday, the UK inflation numbers coming out at 3%, exactly the same level as in the US, 3% for January. In UK,
Yes.
the expectations was 2.8, and in US it was 2.9 last week. Again, should we be afraid of this jump? Not isolated, of course, but we just take it as another sign, and that inflation is not sort of under what we call control. The upside is the risk, and so there's so a spike on the upside is basically the risk what we see, and there's a reason why we take inflation on our top priority list again this week, and actually with a bit more focus than last week, and that is because we give it a lot of attention. It means if we give it priority to truckloads of other topics we could talk about. So it is not only in UK. We also have indications now from the ECB about concerns. Yesterday also, one of the executive board members, Elisabeth Schnabel, she raised her concern. She is a hawk, yeah, should be said, but she has actually prior advocated for cutting interest
Yes.
rates and not around. But now she, public says she is, when she says she's in doubt, she is reconsidering. It's not that she knows, she doesn't know what to do. It's not how we should read her comments. It's actually, she is turning her view. She is moving away from another cut because she says, and she sees the same as we see, that inflation is it's not under control, and is she considers as being more and more skewed to the upside, the risk. And that means the April meeting will be very interesting. It is still so that if we look into the futures market, the majority of the market expects a rate cut in April, but it is the majority is narrowing. Right now, it's sort of again based on how the market is positioned, sort of a 60% expectation of a 25%, 25 basis points rate cut in April when the European Central Bank meets there. Now, here at Long Greens, we argue for no rate cut. And the reason is we could see a few more steps in the inflation pressure on the upside before the meeting.
Yes.
And now, well, we had the story about the rise. It won't affect
Yeah, for
our
sure that adds to it.
inflation towards in Europe, but as it is just sort of all the way. We see it on producer prices as well across the world, less in Europe because there's sluggish demand, particularly in Germany and France. But it is moving. The pressure is moving up, so to the upside. So what does it mean? It means exactly what we have been talking about since basically since the US election last year, that this rate cut tailwind disappears for the stock market. Now it also there's a risk it disappears in Europe as well. The very last sort of tailwind we see also from the US Central Bank Fed. The comments are that rate cuts might come, but they are more likely postponed.
Later,
So,
yeah.
so
Later.
the tailwind actually, as we consider here, we would argue it has gone. It is not there anymore.
Mm-hmm.
Basically, this is how we should think, and it also means that we are seeing a very, very strong floor on the interest rate, and that is from basically from the very short end to the long end. Because if it's inflation that is driving the central banks to stop cutting, then it will also pressure the long end of the curve upwards. So this is important, and this is why we give it even more attention today. It doesn't mean that the stock market will be hurt.
Yeah.
Well, I think we see it still both as pretty robust also, how about in Southeast Asia? Are people nervous? How are investors doing?
Well, there is some pressure regarding inflation, especially on the producer side. But as far as consumption remains robust, and especially when you have stuff like rice and food that's climbing, it
Mm,
will hurt a bit, but people won't necessarily stop consuming these items, for example. So consumer goods consumer stocks, for example, will continue to grow, maybe just not as upbeat as it would have under a low inflation environment. But yeah, a lot of central banks as well in Asia, at least or in Southeast Asia, move in step with the Fed as much as they won't admit it to be publicly. So, if a pause occurs with the Fed and with the ECB, for example, that's more likely where they will go. Um, except for cases like Japan, for example, where they're doing the opposite, where they're starting to hike rates. Um,
mm,
when inflation rises, that's giving them more a bigger cue to go ahead with the rate increases, while the rest
yeah.
of the region will likely stay on hold.
So this is the outlook, basically. Central banks on hold,
Yes.
apart from a few. But in general, they're on hold. Um, then we can do some speculation. Okay, what about if the world sort of starts to falter and global growth turns even lower? Could
Mhm.
that force the central banks to cut the rates? Yeah, that it could actually be the case, but then we are entering sort of another negative scenario. Um, it's not where we are now, but that would actually not necessarily be pretty good for the stock markets. Right now, we see, we have mentioned, the dominant tech sector seems to be doing okay. Yeah.
Yeah.
Fundamentally, we see all major sort of global companies doing fine, but they are also their own economies. They're so big that they represent their own economy. They can keep up the stock market. What happens down in sort of the mid-sized sector is different. Yeah. Everything can happen. That would be more dependent on domestic growth or regional growth. So yeah, things can change, but right now it's not that we are turning negative on the stock market. We are just saying that the tailwind from expected rate cuts are also fading out in Europe now. We don't see it come. So it's more up to the corporate profitability to keep stock markets up. And of course, it would be good with some GDP growth as a sort of a macro tailwind. Anyway, but this is getting highly interesting, I would say. Inflation is a theme that will grow among investors we trust. And the thing is, could it also influence the greenback, the US dollar? Maybe is the answer. We have several times, I would say, in the past 4 to 5 months, touched on the greenback, saying, is it trading at the very high end of a trading range? And that is actually more and more what we argue, in particular against the euro. That means the dollar could lose 5 to 7% against the euro. And it's not because the euro is sort of entering a particular strong area. It is more that there were some expectations about further rate cuts in Europe and in the US might, it was obvious after
Mhm.
the election that the interest rate outlook were different, yeah. And then we had sort of the last dollar spike, and now the euro might gain a bit on a stop in rate cuts.
Mhm.
Um, we of course have Russia that might be sort of back on the scene with some importance, and that would be a threat to Europe. Could be euro negative, absolutely. But if a crisis or fear mood is spreading across the globe or in certain sectors among as a sort of in large investors, what would happen? Normally, you say, "Aha, U.S. dollar is a safe haven.
Yeah.
These days are gone." Typically, people will go cash if it's real crisis mode. And U.S. has issued so much debt that people will sell the US Treasury bonds and take the money back home. That could actually pressure the US dollar if a crisis mode sort of spreads. And then we are seeing probably Japanese yen go strong, Swiss franc, of course, all of these sort of kind of currencies with a strong domestic wealth. Yeah. So this is what could happen. So a crisis is not necessarily positive for the US dollar or crisis mode.
Mm-hmm.
Again, therefore it could easily be that we see the US dollar in its upper end of the range right now. And again, for the investors who are investing into emerging markets, particularly in Asia, the currency moves have always been important. So it might be worth to have a closer study of the US dollar.
Yeah.
Yeah. So much to our different subjects for today. Let's do the final round. Sum up on the global outlook. Mel, are we happy or are we nervous?
Well, there have been some concerns that we have been not necessarily flagging, but monitoring over the not just this episode, but our past episodes. So inflation is very much a big theme in Asian markets, as it is in Europe, for example. There is this rice supply concerns that is pushing inflation higher in select areas. But other than that, we still see strong engines of growth here in Asia. The key really is to boost private or household consumption more. At the time when there's greater global uncertainty, you really want to look into your domestic sources of growth. And that's what economies are trying to do here early into 2025 and in the face of tariffs, for example. So, other than that, we remain bullish about investment prospects in this region. We continue to have an overweight view towards Asian markets, Peter. Although we do keep an eye on these developments.
As we consider the sunshine to be dominating. We prefer globally also to overweight risk still, despite we have all these conversations about what could be a threat. Yeah, it means we are observant. We do see some clouds on the horizon again, as always, but they're not here yet. They might disappear again. So we are overweight risk. That is means overweight, of course, stocks. We're still happy about the credit market, despite there's no more rate cuts, but we see basically the fixed income market in sort of more just a stable scenario. And
Yes.
yeah, that's basically okay for us to be overweight risk. The world, there's a lot of noise coming out of the Oval Office, yeah. But we shouldn't forget that a lot of corporates, they can also perform very well in a noisy world. So that is important to take that view, I believe. So yes, that was basically all what we have in today's podcast. We'll say thank you so much to all the listeners out there. Thank you to you, Emil, for joining in. It's been great as always. And yeah.
Thanks, Peter, and thanks to our listeners as always.
We will be monitoring global developments and will share what's interesting in the next episode of Sound Economies, Mel and Peter on the Global Financial Markets, a podcast by Lundgren's Investor Insights. Thanks for tuning in. For expert insights on the go, download the Lundgren's Investor Insights app for free. For investors, we offer very exciting and high-quality alternative investment funds, including our top-rated mutual China fund. To know more, visit lundgrenscapital.com.